Hey everyone, and welcome. Today we're diving into a huge topic, how to build real long-term wealth. And we're not just going to throw a bunch of random tips at you. Nope. We are breaking down the actual blueprints from an expert who helped manage money at, you guessed it, Goldman Sachs. So let's get right into it. Does the whole world of investing just feel completely overwhelming sometimes? You know you should be doing something to grow your money, but the number of options out there can be totally paralyzing, right? So how do you go from just saving money to actually building wealth that can last a lifetime? Well, that's the exact question we're going to answer today. So who's our guide on this journey? Asha Ofori. She's a super seasoned investment strategist and yeah, an alum of Goldman Sachs. So you could say she knows a thing or two about what it really takes to build serious wealth. We're going to break down her core strategies into a clear, actionable plan that you can actually use. Okay, let's start at the very beginning with the absolute bedrock of any solid financial plan. This is section 1, what Asha calls the foundation. Seriously, think of this as the non-negotiable first step for pretty much everyone. So what exactly is this foundation? Well, it's a portfolio built on two key ideas, diversification and low costs. We're talking about things you've probably heard of, like index funds or ETFs. Those are exchange-traded funds that basically track the entire market. The goal here is not to get rich overnight. It's about capturing the steady, reliable growth of the whole market over many, many years. And do you know the best part? It's actually incredibly simple to set up. First, you open a brokerage account. Then you pick a broad fund, like one that tracks the S&P 500. Then, and this part is absolutely key, you set up automatic monthly contributions. And finally, you make sure any dividends you get are automatically put right back in to buy more. That, my friends, is the magic of compounding in action. Now, why is this so powerful? Well, just look at the numbers. Historically, the S&P 500 has returned an average of about 7 to 10% a year over the long haul. This whole slow and steady thing is a proven engine for building wealth, and it saves you all the stress of trying to guess what the market's going to do next. All right, so our foundation is firmly in place. It's solid. Now, it's time to add a little bit of acceleration. This brings us to strategy number 2. The growth engine. This is where we start looking for ways to maybe, just maybe, outperform the market. So what is the growth engine? This is where you step away from those broad funds and start picking individual stocks. We're talking about companies in high growth areas like tech or renewable energy. But here's the crucial thing you have to understand. This comes with higher risk. The flip side, of course, is the potential for much higher returns. And this illustrates the main difference perfectly. The foundation? That's passive investing. You can basically set it and forget it. But this growth engine, oh no. This is active investing. This requires your time. It means doing research, doing analysis, and keeping an eye on your investments. I love how Aisha Ofori puts it here. This is not about chasing hot tips you heard from a friend. It's about having real conviction. You have to do the homework and find companies you genuinely believe in and whose business model you could actually explain to someone else. That is the real secret to being good at this. Okay, so we've built the foundation. We've fired up the growth engine. Now, for those who have a bit more capital and expertise, there's a third level. Let's look at strategy number 3, the advanced play. This is where both the risk and the potential reward get turned way, way up. So what are we even talking about here? We are moving completely beyond the stock market. We're talking about alternative assets, things like investing directly in real estate, or even angel investing, which is where you provide the early cash for brand new startups. Now, these things are often illiquid, meaning you can't get your cash out quickly, and they take a lot of money to get into, but the potential payoff, it can be absolutely exponential. But hold on, before anyone gets too excited, you have to look at the warnings here. They are crystal clear. It takes a lot of money. You can't get that cash out easily. The amount of research or due diligence is just intense. You have to be patient for a really long time, and you have to be okay with a very high chance of failure. This is absolutely not for the faint of heart. This chart really puts the whole thing into perspective, doesn't it? You can see the relationship perfectly. As you move from the foundation to the growth engine to the advanced play, the bar for potential returns just climbs and climbs. But so does the risk. It's the fundamental trade-off of all investing right there in one simple visual. So, we've got our 3 blueprints, the foundation, the growth engine, and the advanced play. Now comes the most important part of all. How do you put these pieces together to build your financial future? This table is basically the perfect cheat sheet. It lays it all out. The foundation, low risk, low capital, passive. The growth engine, kind of in the middle on everything. And the advanced play, high risk, high capital, and very, very active. Seeing them side by side like this makes it so clear which approach might fit you. And this brings us to what might be the biggest takeaway from all of this. There is no single best strategy that works for everybody. It just doesn't exist. The right approach for you is probably some kind of blend. It all depends on your own goals, how much risk you're actually comfortable with, and your timeline. Your blueprint should be as unique as you are. So we've laid out the plans for you, from that solid foundation to the high-flying advanced plays. The concepts are clear, the steps are defined. The only question left is the one right here. Now that you have the blueprints, which one, or which combination, are you going to start building with?